Hello and welcome to Multifamily Investing with Bob Biggins. I am Bob Biggins, and today we have a very special guest, Ben Kahle from Wellings Capital, with over 500 million under assets under management. They're a real estate private equity firm helping high net worth individuals, family offices rather, registered investment advisors, and wealth managers access diversified private capital in real estate. They invest alongside carefully vetted operators across manufactured home communities, multifamily, small bay and flex industrial, open air retail, and self storage. Ben comes from Virginia, where he started out as an intern for Wellington's Capital. Very impressive in 2015. Went on to become an analyst and then promoted to an operations manager, then became a partner, chief operating officer. And as of last year or two, I believe, he's become a managing partner of Wellings Capital. So without further ado, Ben, if you could give us a quick bio on yourself, as much or a little as you'd like, family, personal, professional, the show is
Sure,
yours.
sure. Well, yeah, Bob, thanks for having me on.
Yeah,
It's really brief. I mean, I think you hit most of it on the professional side. So, live here in a town called Lynchburg, Virginia. It's about 3 hours south of DC. It's in the Blue Ridge Mountains. Been married for just over 11 years now. We have a son, a toddler, and another one on the way. So,
congratulations.
entering that season of young kids, or we've been in it. But yeah, I think we really focus on um, these historically recession resistant asset types. There's no such thing as recession proof asset types, but we like self storage, we like mobile home parks, we like multifamily assets that have done well in previous downturns. And one point of distinction is we're not an operator. So we're not running these properties directly. We have asset management on our Wellings side that we do, but we're partnering with the operators
Sure.
to invest. And we're investing preferred equity and other types of JV equity. And we have major decision rights, kind of like a traditional private equity firm would buy a stake in an operating business or
Hmm.
maybe buy the whole thing. They're not coming in and running the show necessarily. Sometimes they do, but they can run the show if they need to. So that's kind of our model.
Did you get into Welling? How'd you get into real estate?
Well, I grew up around my grandfather who was in Maryland, and he was kind of a mom and pop real estate guy. He didn't have this crazy big portfolio. He was not this type of person that came from a prestigious background. He barely graduated high school, and he started working in a service station when he was younger. He actually ended up buying that service station, and then he eventually bought a car wash, and then he sold that, and then eventually started doing single family rentals, and then small little single story office buildings, and then kind of just sat tight with that stuff. And so I always kind of had this idea that I liked real estate. He was a big influence in my life. And so I ended up getting my real estate license when I was in college. And that's actually how I met Paul Moore, who's the founder of Wellings. He asked me to do an internship. I met him in 2014. I think I started internship January 2015. So about 11 and a half years ago. This is really the only job that I've done out of college.
Well, eh, so you knew you wanted to do real estate roughly, and it sounds like your granddad, he was a just a serial entrepreneur, just bootstrapping everything. Very impressive. Very
Yeah,
impressive.
yeah. He was a big influence. He did real estate and then he did dividend stock investing. And
Oh,
he kind of had the two things, and he would pour over financial statements for publicly traded companies and um, just kind of do really boring stock long-term things.
Right.
And
Back when you couldn't trade stocks for free or for a dollar or anything like that, it was, I remember even when I was younger, it was like 75 or $100 to trade a stock. I mean,
Mhm.
you didn't take that decision lightly. You weren't going to flip in and out. It was some real money back then just to make a trade because it all went all the way to the New York Stock Exchange.
Yep.
Very, very cool. Very cool. Well, what's a typical day now that you're a managing partner at Welling Capital? What's a typical day look like?
Well, when I'm not traveling, and I travel not a ton, a couple times a month,
Okay.
but when I'm not traveling, I kind of have my week set up in a particular way. So I try to block Mondays and Wednesdays from external meetings unless the meeting is related to an active deal or an investor or prospective investor. And then I'd throw in like podcasts in there.
Mhm.
I try to keep Tuesdays and Thursdays as really heavy meeting days, kind of stack meetings. So
Mhm.
might have 5 to 6 hours of meetings on those days. That's internal meetings and external meetings that are not necessarily mission critical for the business, but are necessary. Um, and then Fridays is kind of a mix. So I think a lot of what I do is I'm not as involved on the capital raise side. So we have a director of capital formation, investor relations. We have an investor relations coordinator, Paul, my founder, or the founder of Wellings, my partner. He's
Mhm.
really involved in the capital raise side of
Mhm.
things. We serve over 1,100 investors.
Wow.
And so, I get involved in that to some degree, but I'm probably more involved on the deal side
Mhm.
with the investment team. Um, so, I think, and then I'm somewhat involved in asset management as well. I say pretty involved in that. Right now, we're going through quarterly reports, so I will review every one of those, maybe provide edits or feedback to our team, and then I'll record a short video along with each quarterly report.
Mhm.
So,
Okay.
we have 8 funds and a handful of sidecar entities. So there's a lot of reporting that
Right.
happens. So that's kind of what I'm doing right now.
Beautiful. Yeah. Yeah. Quick math. That's 32 communication channels per year.
Hmm.
Moving
Yeah.
right along. Um, I read that you've got a 26-step due diligence process. Can you elaborate on that or give me a brief overview of how you guys go about and evaluate a property and do the due diligence really?
Sure. Yeah. So this 26 step process, it's pretty regularly evolving as we're learning things or someone has an idea to
Hmm.
tweak.
Yep.
Um, we do share this with current and prospective investors. So if you want it, I think maybe find me on LinkedIn. It's just my name, Benjamin, and then last name is Kahle. You can just add me and send me a DM, and we can get it over to you if you're curious about it. But it really starts with the operator and their team. We want to make
Hmm.
sure they have at least a decade of experience owning and operating their particular asset type,
Sure.
whatever that is, and then their track record. Want to know every deal that they've sold, every deal they've refinanced, and the details around that. And then from there, we'd want to understand what's in their current portfolio. How many assets do they own? Are those assets covering their senior debt service?
Hmm.
Is there near-term loan maturity that
Hmm.
could be an issue? We want to verify once we really get into things, that they actually do own all those properties. And
Yeah.
so we have a number of ways that we do that. Want to understand how much money they're typically investing in the properties
Mhm.
themselves, like skin in the game. Want to
Mhm.
understand how they're incentivized, like what's their fee structure. Want to understand if they're transparent. Um, when we ask them about how things have gone in the past, we want to see, are they volunteering mistakes that they've made? Are
Mhm.
they, or do we have to like drag it out of them?
Right.
How forthcoming are they? So that's just a few of the things. We have a pre-LOI process we go through, or a pre-term sheet process, and then after we get in term sheet, we have a more extensive process that we go through. So we
Mm.
really just we want to treat the post term sheet, post LOI as verifying everything that we've been told so far. And then obviously the legal aspect probably takes the longest because we're doing a joint venture agreement with all the operators we're investing with.
Sure.
And that it's a big document, and we want to make sure it works for them and works for us. And so, yeah.
Probably always a lot of questions
Mm-hmm.
from the investors,
Yep.
and quelling any fears or any questions that they may have regarding to the deal and the operator and the process, et cetera.
Yeah. Like our investors. Yeah. I mean, so we're investing out of funds. So it's a semi-blind pool for the investors that are coming in. So they're not necessarily speaking in or diving really deep. They're more so
Okay.
getting Wellings and understanding our process. We tell them, of course, about the deals we're looking at and
Hmm.
deals that end up in the fund. Sometimes we'll do a sidecar vehicle or a co-investment vehicle, which is basically a one-off syndication.
Hmm.
Fund will take part of it, and then the sidecar will take part of the deal as well. And sidecars really is for people who might not want a fund. They just want one deal and one asset type to wrap their heads around fully.
Hmm.
So we've done 4 of those. So and investors have liked those so far.
Would you say your mix is between, because this is primarily multifamily channel, what's your mix of multifamily versus self-storage versus um, parks? What's your rough
Yeah,
breakdown?
yeah. I don't have the perfect numbers, but it's something like 50 million we've invested in self-storage, around 50 million in mobile home parks, and probably closer to 60 or 70 million in multifamily.
So
That's
pretty
that's the rough
pretty
breakdown.
balanced, quite balanced. So yeah.
Yeah, and then I think so. We manage around 225 million of investor equity today.
Hmm.
The balance of that would be in retail, small bay, or flex industrial, some RV parks, and then some single family rental portfolios.
Oh wow, single family rental portfolios. Oh, interesting. Um, in your Q1 26 market complimentary blog, I read several of your blogs. You detailed out your improving asset management platform and spending more time at the properties that you invest in. Can you discuss any like wins or losses? Or I mean, being an operator, I understand boots on the ground is paramount important. Things that have worked well for you going into that, or things that you were like, holy cow, I can't believe this, or nope, they're doing better without me. Wins and
Yeah.
losses.
So our process for doing site visits, we don't have this super strict every quarter we're going to be visiting every property. It's typically driven by maybe what we feel like is going on at the property, if
Hmm.
it feels like it needs more attention, or the other thing is draw requests. So when we invest, we're sometimes holding back capital improvement dollars and releasing it in draws as that work gets completed. So it's kind of another protection aspect for our investors. We're not giving
Absolutely.
the sponsor everything up front. So
Absolutely.
we'll release the first tranche at closing, and then maybe that work gets done on the first couple of units, say it's unit renovations.
Mm-hmm.
And then we'll do a site visit and just kind of verify that the work quality is what we expected, that the money
Right.
was actually used where it was said it was going to be used.
Right.
And we and then we can get comfortable with the next draw. It's kind of boring, straightforward stuff, but it's just what it takes. Most of the time there's never an issue. There have been a few times where we went in and things didn't perfectly match our expectations, and so we just have to have conversations
Mm-hmm.
um, with the sponsor and their asset management people about just how to rectify it. I think it's really just always trying to approach things with like a win-win mentality. We don't want to be predatory, preferred equity, or just this really annoying group to deal with. But we have to enforce our position and enforce our rights with
Sure.
the different sponsors. Um, but yeah, I think it ultimately what makes our asset management run smoothly is partnering with high quality individuals
Absolutely.
and good teams. And we haven't got that 100% right all the time. It's and so I could go on about that, but I think the quality of the people is more important than the quality of the deal. At the end of the day, the quality of the deal and the market, all that, it really matters. It really, really, really matters. But people matter more, in my opinion.
I couldn't agree more. A bad operator can make a good deal bad, and a good operator can make a bad deal good.
Mhm.
Most definitely. Well, what do you attribute? I mean, you've seen Wellington now from 15 to present, so 11 years. You got tremendous growth. What are you chalking all your growth up to?
Hmm.
Or any one thing, or any series of things, or
Yeah.
just very impressive.
I think Paul, who's 30 years older than me, he's been
And a
investing.
Detroit guy, and
Yes,
a Michigan guy also.
yes, Michigan guy
Yep.
also. He moved down here in, gosh, I think it was the late 90s
Okay.
after he sold a company. And he started investing in real estate in 1999. And so he has this track record and he's seen a lot. And that was crucial for us at the beginning. And without Paul's track record, we couldn't have done what we did without his story, without his ability to connect with people.
Hmm.
Um, so there was a quiet couple years when I first started. I think we are just figuring things out in terms of just in terms of growth and acquisitions and everything. Um, I think where we really found our footing was when we really started this platform of providing equity to other sponsors in 2019, January 2019. So really, like, all of the growth has been since then. And I think timing is always important. It was a fairly easy environment to raise capital
Hmm.
in 2019, 20, 21. You know, everything was just going up. And so that certainly helped. Podcasts, like Paul has been a guest on probably over 500 podcasts.
Yeah, I've seen him many times over.
Yep. and I think podcasts were less saturated back then
Mm-hmm.
compared to today.
Yeah.
So that helped. He was also really active on a site called Bigger Pockets, which
Yeah.
that site has changed a lot in the last couple of years.
Yep.
I don't, positive or negative, I'm not sure. It's changed. I'm
Mm-hmm.
not really on it personally. And then I think we just got into a good rhythm of taking care of our investors and just trying to put our investors first. And it's led to a lot of referrals. It's led to a lot of repeat investors in 2024 and 25. Over 70% of the capital we raised was from previous existing investors and just investing more with us.
Wow.
And that's something that we think it's good. Obviously, that investors are trusting us again, but it's also bad in a way because we're not reaching new investors. But that's okay. Um, we'll reach the people we need to reach as long as we just continue trying to deliver real returns. Like we're not trying to be growth focused. We're just trying to be returns focused.
Mm-hmm.
And if we don't grow, like this year, I don't know how much we're going to grow compared to previous years.
Yeah.
But it's okay with me as long as we can stay true to our values and um, just do the right thing for our investors. And I think real estate's a long-term game.
Mhm.
I saw that with my grandfather. If you can just do the basics over 10, 20, 30, 40 years, not make any major mistakes, hopefully,
Right. Right.
it should go well for everyone. It should be conservative with leverage.
Mm-hmm.
But I think people get into trouble when they try to go too quick with real estate. It's
Sure.
not like tech where you have to go quick
Right.
and you need that explosive growth. Um, Real estate's just a different animal.
Sure. Consistent, boring returns. People love them. Return month after month, quarter after quarter. Absolutely.
Yeah.
Absolutely. Well, next steps for Wellings for Ben.
Yeah. So the audio cut out a little bit, but I think I heard the most of it. So in terms of what's next, kind of going back to what I just said a second ago, is just more of the same,
Yeah.
hopefully.
Yeah.
Um, just kind of continuing to do what we've done. We don't want to, we're always going to be looking for the unique angle in the market. Preferred equity was a big thing that we were focusing on in 2023 and 24. That's shifted a bit. Who knows what the next thing will be within commercial real estate for us. We're not trying to time markets or time cycles perfectly. We're just trying to do the best deals that we can do with the best people we can find. And hopefully we can just keep doing that and then bring on really good team members and
Sure.
retain good team members. That's what it's all about is, hiring people smarter than me and
That's
better than
formula
me.
for long-term growth is just better and better people, consistent pipeline of people and deals. It's
Yes.
just a consistency, lots of singles, lots of singles. Well, Ben, is there any other way that you want people to reach out to you other than LinkedIn?
I think LinkedIn's probably the best. I've been
Sure.
pretty active there lately. Yeah, if you
You do have
just
very impressive content on there, by the way. I mean, a lot of good content on LinkedIn.
sometimes maybe, but no, I appreciate it. I appreciate it. Yeah, I think just look me up on LinkedIn, send me a DM in there, and we can connect and stay connected that way. Um, I've been learning a lot on LinkedIn from other people as well. So I was pretty much off of it for a number of years, and I think I should have probably got back on earlier.
Yeah. Well, Ben, I appreciate your time. I appreciate all your wisdom you impart on my audience, and more power to you. If you guys are ever in Michigan again, you or Paul, come this way. We got a great area right here on the beach and
Yeah, it's super
Southwest
nice.
Michigan, Lake Michigan. We're right on Lake Michigan, and so by all means, always invited.
Awesome. Thanks so much, Bob. Appreciate it.
Thanks very much, Ben. Appreciate it. Take care.